So today is the 2025 IRMAA Show. Yippee. So IRMAA, income related monthly adjustment amount. That's a mouthful. Another acronym, don't blame me for it. It's from Medicare. And this is the surtax on the well-to-do that are uncovered by Medicare. I mean, in other words, because you make a lot of money in retirement, you get to pay a whole lot more for Medicare. It's just that simple. And we're financial planners. And this is one factor among many that we look at, try to manage, try to work around, try to reduce, perhaps make it go away with an appeal. So we're looking forward and we're trying to make this the best they can. But I want to push this now to Tom, and I want Tom to tell you why we're shooting this video, why we're covering IRMAA 2025 today.
Yeah, I mean, we're doing this video because of everything that we do in our practice, which is a lot. This is the thing that angers the most. People get the most angry about this. And the real reason for that is they have no idea it's coming most of the time. And so they get this letter, and it's like they've finally signed up for Medicare. They're all excited about it. And they get this letter saying, oh, by the way, we're going to charge you more than what the stated amount is, the normal amount, because of your income. And people get hot. I mean, it's a little bit amazing of how angry some people get. And then what they do is they do all their planning around how to avoid this, which oftentimes is not the best idea. And so, again, we just want to walk you through it. And there are ways to appeal it, and we'll get to that in the video. But again, you need to know about this. You need to know what's coming. And when you know it's coming, no one likes it, right? I'm not going to try to make you like it, but at least you understand it, right? You know what's happening, you know, and you expect it. And I think that is a much better way to enter into Medicare, at least with clear eyes and knowing what's going to happen. So let's bring up the show notes here. These are at the link below our video. They're also on our website at cardinalguide.com. We have the board, so some people will print this out. They'll take notes on it. A lot of times, if you're watching on your phone, it's going to be kind of hard to see it sometimes. So again, we've had a lot of people do that. We have this is actually an example of a letter, an IRMAA letter that one of our clients got that really just shows you kind of what it looks like when you get this letter. It typically comes, late in November for the following year. If you're signing up for Medicare for the first time, middle of the year, typically you'll get your card. You'll get a letter saying we approved you for Medicare. You get another thing in the mail with your card, and then this one is soon to follow, saying, "Oh yeah, by the way, we're going to charge you more." So this is what it looks like. It walks you through the amount that you're going to pay. We have this is for 2025. These are the IRMAA thresholds. These are the income amounts that get you to there. We'll walk through that on the board as we go along. And again, this chart we have this in a lot of our videos. I think this is really good. Gives you an idea of the different tax brackets. A lot of different tax good information is on this one. And again, we'll come back to this as we go through. But this is the form where there are situations you can appeal this IRMAA where you can get it to be lower than what they initially told you it's going to be. This is the form you use to do that. So as we go through the show, we'll reference back on this form here. And so a lot in the show notes. If if something piques your interest and you want to go get more information, you can find them in the show notes here. So I'll turn it back to Hans. We'll get onto the board and then we'll go from there.
Okay, so I'm going to try to go through quickly the IRMAA charts. These are the brackets. So in other words, if you're filing or you filed in 2023 a married filing jointly return and it was less than $212,000, you're not going to pay any IRMAA. Okay, you're just going to pay the $185 a month for Medicare Part B for the whole year of 2025. If you were $1 over that, you're going to pay an extra $74 a month for Part B, and you're going to pay an extra $14 for Part D. Now, if you were somebody that made $400,000 to $749,000, you're going to pay the $185 plus you're going to pay an extra $407 for your B and an extra $79 for your D, or you're going to pay $58.32 total extra for IRMAA plus the $185 a month. So it's going to put your IRMAA costs at about $8,000. And married filing joint, that's for two of you if you're both on Medicare. So it makes Medicare pretty expensive. This people get upset about this, and Tom's going to go over a little bit of that later. These are the brackets, and it actually, these are the tax brackets, which we've had in lots of our videos. We got them in the show notes. And, you know, when you get somebody that's over 400 grand, you know, on married filing jointly, they're in the 32% tax bracket. Anyhow, ordinary. Then they got state income taxes to pay. And then this IRMAA is really small in comparison to the taxes they're paying, but it really gets people going. And so we're going to just try to give an overview of this thing quickly, and we're going to get in and give you some examples. So the first thing to learn is they're going to use your 2023 return to calculate IRMAA in 2025. And if you're already paying IRMAA, you got one of these letters. This one was dated November 27th, 2024. So along about Thanksgiving every year, you're going to get, and this was last Thanksgiving, you're going to get this letter, you're going to get this love letter from Social Security that says, we pulled your 2023 tax return, and in 2025, it plugs all this stuff in based on your tax return. And if you're husband and wife, you're going to each get your own letter. Okay? So understand it's looking backwards 2 years. If you cross the threshold, you pay the entire amount, so it's not a percentage. They have a separate calculation, which is called MAGI, Modified Adjusted Gross Income. So they're going to add in your tax-free interest. So when this IRMAA first came out, a lot of people put their interest earnings in tax-free bonds to avoid this. And so that avoided it because it didn't raise their tax brackets, but then they came up with this MAGI, Modified Adjusted Gross Income. So if you have tax-free bonds, they're not added into your taxes, but they're going to be added to your adjusted gross income to calculate IRMAA. So that workaround doesn't work anymore. Your RMDs increase IRMAA. So we have a lot of people come to us in their mid-60s, just going on Medicare, and they're looking at this IRMAA, and they're also looking at a whole bunch of things like Roth conversions of their IRA. And Roth conversions are really bad for IRMAA. In fact, it creates a stop sign in many clients' eyes where they're going to say, oh, I don't want to do a Roth conversion because it's going to make my IRMAA higher. And they're correct, it will. Now, the bad news for that is if they're not pulling any money out of their IRA, or very little, until they're 73, they're going to hit required minimum distributions. And if they've got a very large IRA and growing IRA, their RMDs, or their required minimum distributions at 73 and beyond, are going to be so high that they're going to have a really big IRMAA to enjoy for the rest of their life. So think about that a little bit. And Tom's going to speak to you about that a little bit more. QCDs, qualified charitable distributions, can reduce IRMAA because it doesn't show up on your tax return. It counts as a required minimum distribution. So if you're charitably inclined, we can plan for qualified charitable distributions to give your minimum distributions to charity, or some of them, and that'll reduce your adjusted gross income, count toward your RMD, and possibly save you money on IRMAA. There's a possibility of doing an appeal. So if you have a life event, let's just say you retired in 2025 or 2024, and using your 2023 income while you were working is driving a big IRMAA, but your post-retirement income is going to be less. So you could do an appeal, because as long as you have one of these life events, which is married, divorced, spouse died, stopped work, reduced hours, there's a number of those on the check boxes, but most of the time it's that they've reduced their hours at work, or they've retired and they've stopped working. And this counts for your spouse as well. We can help you with an appeal. And Tom was saying there's an appeal form in there. Not going to get into the details of it so much. We can move your income through the appeal, we can move, they're using your 2023 income. And because of the life event, we can get them to look at your 2025 projected. And if that could bring you down a bracket or two, or perhaps eliminate IRMAA, then the appeal is going to be successful and they're going to put that benefit in for you right away. So if you need help with something like that, just give us a call. We'll be glad to talk to you about it. In Roth conversions, we just made the point down there that they actually increase IRMAA in the present, but it's just for 1 year. And so Roth IRAs have no required minimum distributions. So you're going to pay an IRMAA penalty or IRMAA tax for 1 year to get the benefit of a tax-free income later on that could go on for several years and then even on to your heirs if you don't touch it. So I'd like to bring Tom back on, and I want Tom to just give you his slant on this whole thing.
Yeah, I mean, I think, like I said in the why of the video, right? I mean, really what upsets people the most is that it just is they don't know about this. And it does feel a little bit frustrating that they're using my income from 2 years ago to charge me more for Medicare in this year. And that's where the appeal comes into play because a lot of times, let's say the reason you're starting Medicare is you've just retired, which is typically what's going on. Well, if your income is now less, let's use the appeal. Let's get that down. And I think a lot of scenarios, it makes a lot of sense to do that. Let's get it removed. No harm, no foul. Everyone's happy. But I want to now speak to the people that have really large balances in IRA. So, 1, 2, even 3 million in IRAs. I mean, again, these people have an IRMAA problem. And it's just whether you're going to pay it now or pay it later, right? And again, everyone's situation is different. When we do a plan, we model this out looking to the future. But one of the things that I look at is, are your RMDs when they start, which will either be 73 or 75 if you were born after 1960, are the RMDs going to push you into these IRMAA levels anyways? And if so, then we might be better off accepting some level of IRMAA, doing things like Roth conversion, which is pushing up your income to higher levels, intentionally having you pay more for Medicare now to avoid the higher costs down the road. And so, and that's what I was talking about, where these people come in, we're not doing a plan for them, and they're doing everything they can to keep their income below, let's say the $212,000 range for a married couple. And it's very short-sighted in some scenarios, right? And so again, I just want you to be thinking critically about this. And that might mean paying some IRMAA now, maybe not going all the way to the top of the IRMAA thresholds, but going to the first, second bracket again. We can talk about that as we're doing the plan. But doing some now to avoid it later, I think can make a lot of sense. Now, if you have sort of a moderate amount in your IRA and we can manage this while doing still some tax planning and avoid the IRMAA, great. I'm all for that if it makes sense for your plan. But just sometimes it doesn't. Sometimes you need to go into those higher thresholds. I think the other thing that a lot of people miss is what happens when a spouse passes away. So now I'm talking to, if you're married and you have a couple, you're filing joint tax returns, you can look at the IRMAA thresholds. They're essentially double what the single thresholds are. And so, you're going along and doing just fine. But when the first spouse passes away, and so I'm gonna use the husband in this example. The husband passes away, and the wife is going to live on for potentially many years after their death. The RMD amounts really haven't changed because as a spouse inherits IRAs, they still have the RMDs they have to take out. Again, so the gross income really hasn't changed at all. There will be some reduction from Social Security, but let's focus on the IRA for right now. The IRA is coming in, the RMDs are coming in. They have to pay the taxes. So now they're filing taxes at the single tax filing rate. So this is ordinary income tax brackets, which are higher taxes. Their IRMAA brackets have been cut in half, and so now they're having to pay more for Medicare, and they're having to deal with the loss of their spouse. That is a really bad scenario to leave your loved one in after you're gone, right? And so I think you want to be thinking through, not only what does it look like now, but what does it look like into the future, and planning for if one of us dies, where does that leave the other one? And again, those are some of the things that we want to think through as we're doing these financial plans. And again, this isn't to make you like IRMAA. I've never met anyone who loves paying this, but I think if you can go in, have a plan in place, think about this critically, it can make some sense to pay it to avoid higher costs down the road. Again, it's very dependent upon your situation. Call us. We can put a plan together, and we can come up with what makes the most sense for you. But I just want to push back on some of these people that get really upset. They do everything they can to avoid it, and sometimes that's just very short-sighted on their part.
Yeah, Tom, I'd like you to bring up that Irma appeal form in the show notes. So you can go find that. You can Google it as well. Um, but the Irma appeal form, the appeal is actually pretty simple, but you wouldn't believe how many people mess these things up on their own because they just don't really have an understanding of this. We're more than glad to help you with this. You still have to fill it out. I mean, we can't fill it out for you and apply it, but it's just, I just want to show you where it is. You can go find it in the show notes and encourage you to just give us a call, send us an email, and first we can decide if an appeal is going to work for you or not. I mean, we can help you that way, and then if one is going to work, then we can plan out with you and show you how to fill out this thing in such a proper way. And then I want you to pull back to the letter. I've been holding this letter in my hand through the whole, and I actually used this letter, which everybody that's on Irma gets one of these in November. I used this to just write the show and prepare for the show because it goes through everything, the appeal, the brackets. It doesn't have the tax brackets on there, but they're in the show notes as well. So what I'd like you to get from the video is that, you know, this is something that's there. People with a high income have to pay more for Medicare. I mean, it's just if you have a high income in a retirement, and for a couple, a high income is defined as 212,000 or more. For a single person, it's defined as 106,000 or more. Um, you know, and if you're just over that, the IRMAA penalty is not too stiff. But if you have significant amounts over that, you're going to pay more for Medicare. And we, as financial planners, as we look to the future, we can do things to as the trade-off, and we can structure your money in such a way that you're going to look more favorable with this. But what we never want to do, and we advise people, is don't let Irma sit in the front seat of the bus. I mean, don't let Irma be the driver of all things. And people get there really out of anger, is they want to get this thing down. And if you're a person that has this much income, you've done a lot of things right to get to there. And don't start messing that up over this Medicare tax. There's some people we just tell them pay it. And let's work on the overall taxes on the big amount. And let's try to make that more favorable for you. So in terms of comprehensive planning today, we've talked, I guess, a little bit about Social Security because that enters, your Social Security check enters into the calculation of this. We've talked about IRA, 401k, and certainly Roth conversions are a driver of income, and then it's going to affect you 2 years later. We talked about income because this is what's driving that. And this whole show is about taxes and obviously Medicare. I missed that. This is the Medicare tax. So I'd like to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
I want to thank you very much for listening.
Thank you.